Hello everyone. Very good evening everyone. I am CA Sonam Khandelwal and I'm delighted to welcome you all of this webinar on ISD mechanism under GST and New Income Tax Bill 2025 organized by the Continuing Professional Education CP Committee of the ICAI. This is the first webinar of this council year and we are pleased to announce that we will be conducting such session every Friday at the same time. So I encourage you all of to block your calendars for future sessions. The role of the
Madam, sorry to just interrupt. I am Ajit Tiwari, Secretary of CP Committee. So this, this Wednesday event, this webinar, we have been doing from last 2 years, but now, it's a suggestion and it's going to be implemented from next Friday, that session would be held at same time, 4 to 6. This is small update only for the members because they are, our continuous regular members. So from this year, for this whole year, we would be organizing every Friday, 4 to 6. This is one update here. Yeah, ma'am. Please continue, ma'am. We have the vice chairman also of the CP committee. So please continue, ma'am. Sonamji.
Okay, sir. The role of chartered accountant is constantly evolving in today's dynamic global business environment. The CP committee of ICAI ensure that members stay updated with the emerging areas of taxation, finance, and compliances. Through workshops, seminars, conferences, and background material, the committee facilitated learning and skill development for members. Today's webinar consists of 2 insightful sessions by the expert speaker. Session 1, ISD mechanism under GST, held by CA Yash Dadda sir, and session 2, New Income Tax Bill 2025, Transforming India and Tax Landscape, speaker CA Prakash Parwal sir. Before we begin, I would like to highlight that this session will be conducted in English as we all the participants across the globe. To begin, I would like to introduce our Vice Chairman of CP Committee, CA Vishnu Agrawal sir, Central Council Member of ICAI 2025-29, Vice Chairman of CP Committee and Direct Tax Committee, author of the book Landmark Judgment of Income Tax, over 2 decades of experience in income tax and professional leadership, actively involved in community and social initiatives. Now I'd like to invite C. Vishnu Agrawal sir for welcoming the address. C. Vishnu Agrawal sir.
Thank you, Sonam, Madam. Respected, yes. My Honorable Central Council Member, Satish Kumar Gupta ji, and Chairman of this particular committee, and today's speaker, Yash Dadda ji, and Prakash Parwal ji, and our moderator, Madam Sonam Khandelwal ji. I welcome all of you, all my esteemed members who is online present for waiting for our speakers, Yash ji and Prakash ji both. I welcome all the members, my speakers, and my Central Council member, Satish Kumar Gupta ji. From last years, this committee is organizing every Wednesday the 2 hours program for benefit of all the members. But from this year, our chairman has decided to organize for this program on the Friday because in the Wednesday is the working day and more and more people can attend this program on the Friday evening at the same time. Friends, I will not stand between you and our Yash ji and Prakash ji Parwal ji, who are the expert on the GST and the income tax, and we all are eagerly waiting for both of us. Friends, with these words, I again welcome all of you in this particular program. Thank you, friends.
Thank you, Sri Vishnu Agrawal sir, for insightful address. Now, let me introduce our chairman of CP committee, C. Satish Kumar Gupta sir. C. Satish Kumar Gupta sir, Central Council member of ICAI 2025 and 29, and has served as a CCM for the term 2019-2022. Currently, chairman of CP committee, former chairman of SMP committee and SAFA and CSR committee. Recipient of several awards, including Excellent Branch Award and Special Silver Shield Award, author of more than 8 papers, and regular speaker on GST income assessment and reassessment. So I now invite C. Satish Kumar Gupta, sir, for welcoming the remarks.
Thank you, Sonam. Thanks a lot. My dear Vice Chairman of the committee, Vishnu Agrawal ji, my elder brother, PC Farwal ji, and my younger brother, Yes Dadda ji, and my dear friends attending this webinar from the entire country. Let me welcome you all in this first virtual seminar of CP committee for this council year 25-26. And friends, the topics selected by the CP committee in this first webinar are very important topics. One on GST and another on income tax. The topic on income tax is on Income Tax Bill 2025, which is a very big and milestone event for all the professionals having practice in the income tax. And even the members who are not practicing income tax, I would request them that kindly go through each and every provision of this Income Tax Bill 2025. And it may lead to your occupancy in this income tax topic, and you can go ahead in the practice of income tax law. Friends, CP committee is very important committee who governs the continuous profession education of all the members of the institute. And friends, what we are not only organizing the CP programs, we are giving the CP credits also. You will witness a survey form very soon by the CP committee. And I request each one of you who is attending this seminar that kindly spare few 5-10 minutes of yours and fill that form so we can understand that what are your likings in the CP programs, how do you prefer to implement the attendance record so we can have a maximum attendance of our members and giving them maximum benefit out of CP programs. And your suggestions mean a lot to us. So I request you that kindly spare some time and fill that survey form so our team can ascertain the interest topics. So, and friends, this program of webinar will be held every week. Today is on Wednesday, but from the next week, we are going to organize this program on Friday. Every Friday, 4 to 6, you will have a webinar. Exceptions may be there, few exceptions may be there, but generally on every Friday, you will have a webinar from the CP committee. And I request you that you attend and give your suggestions for the improvement of this program. So, and if you have any other suggestion, you feel free to send your suggestion to the CP committee. We will take care of all your suggestions. And if any leadership of our branches or the CP committees or the chapters are also attending this webinar, I welcome them to the All India Management Committee members meet going to be held in Hotel Andaz, Aero City, Delhi from 21st March to 23rd March. So I would request them kindly ensure your presence there, and it will be our pleasant moment to meet you. Thank you very much. Thanks a lot. Thank you, Sonam, for nicely conducting this webinar as a master of ceremony. Thank you very much. Thanks a lot.
Thank you so much, sir. Very thank you. So, our first speaker today, Yash Dada, sir. We move on to the first session, ISD mechanism and the GST. Our expert speaker, C. Yash Dadaji, having a more than 13 years of experience in the field of indirect taxation with the concentration only on GST, service tax and excise matters, and currently handle litigations along with the advising clients, structuring transactions, and conducting due diligence in the given field of taxation. He is also Optional of the CI Rajasthan as GST, Service Tax and Excise Advisory for industry members. He represented ICAI in Regional Advisory Committee, Rajasthan, under aegis of the Chief Commissioner of Excise and Custom, Jaipur. He has written handbooks on principle of classification for goods and service tax under GST and casual taxable person for IDTC of ICAI, has deliverable structure in across India, is also a regular attendee of various studies across GST conductees by the BACS, CTC, ICI, and other forms of group leaders and coordinator. He is also engaged in grooming young professionals of CACS and MBA on topic of soft skills and professional life management. So I would like to, sir, please take your sessions.
Thank you so much, Sonamji. Thank you for your kind
Thank
words. Respected Satish Gupta ji, Central Council Member and Chairman of the CPE Committee. Respected Vishnu Agarwal ji, CA Vishnu Agarwal ji, Vice Chairman of the Committee and also Central Council Member. You can see Secretary Ajit Nath ji also, and all the participants, fellow chartered accountants who are attending this webinar. At the outset, first of all, I would like to thank the committee for giving me this wonderful opportunity to be a part of this first webinar of this new tenure. And I have, in fact, in past attended some of the programs, and I've always found them very enriching, insightful. So in that sense, also it's a pleasure to address the participants here on this interesting topic of input service distributor under GST. Whenever I start and when I share my presentation, I always say that in my first slide, what you see as a loading is something. This is not something which is a technical error on the part of the platform or my presentation, but that's the state of GST currently in India. It is not settled yet, and it will take some time to settle down. And in fact, this new mechanism of input service distributor, which is technically not new, it has been part of the statute book ever since GST was implemented in India. But in the 8th year of its existence in India, from 1st of April 2025, input service distributor compliance is going to be mandatory. And hence, this appears to be absolutely a correct time where all of us actually go back, look into the nitty-gritties of ISD, see to it that at our relevant workplaces, be it as a consultant or somebody who is taking care of the compliances, or somebody who is working in the industry and taking care of the tax part of the job profile, to see whether you or your cases fall under this concept of ISD, and if it is going to be mandatory from 1st of April 2025, what needs to be done at your end, and what are those preparedness which is required currently in next 15-20 days. So before we deep down into this concept, before this, it makes sense actually to take a step back and think about it, that why in the 8th year of GST suddenly government has said that ISD is going to be mandatory from 1st of April 2025. And the background of this is actually in this phrase that GST is a destination based consumption tax. When we say it's a destination based consumption tax, we know that our GST, in comparison to the GST which is there across the globe, ours is a unique case because we do not have a single GST system, but what we have really is a dual GST. And because of that, the boundaries of the states are very relevant in terms of determining that what is going to be the tax that needs to be paid on a supply transaction, depending upon whether it is intrastate or interstate. And because we have dual GST, where one portion is CGST and another portion is SGST, and the cover of that in case of interstate transactions is IGST, suddenly this dual GST makes the map of India like this only in respect of taxation perspective, meaning thereby that collection of GST in respect of one state government is not dependent upon as to what is the collection of GST which has taken place in another state, but to the extent of the consumption which is taking place in a specific territory or a geographical location. And that is the concept, a broader concept on which this whole indirect tax is premised upon. It would determine that what is that tax collection which is going to be there. Now, if I take this example further, and with this, we'll go back to this concept, to this opening question which I just raised, that why ISD has been made mandatory. Think about a situation where, let's say, some goods from outside India are entering into India, and all of us know that today we pay basic customs duties and IGST on it. Let's say they come to the port at Gujarat, and from Gujarat, these goods go to actually Rajasthan. When they go to Rajasthan, whosoever is actually going to make that supply, he will charge IGST. From Rajasthan, let's say from one city to another in Rajasthan, those goods move as a supply transaction, and then it will cause levy of CGST, SGST. Then from Rajasthan, let's say if it goes to another state, again there is going to be IGST. Think about a situation if, let's say, after that, subsequently, if goods are ultimately consumed in some another state, but tax is not moving, and that consumption takes place in a situation where the entity which had last received an invoice has a branch office in another state, and they prefer not to charge any tax on it, not to raise any invoice on it, considering that ultimately it's a one company which is in existence. Then what is going to happen? Well, ultimately, the new tax to the government would only come from when there is a supply happening between two independent parties. But the problem which is going to be there, that the consumption of the goods is going to take place in state B, whereas the tax will stop in state A if that movement is not taking place. This concept has been well understood in terms of goods. And in fact, because goods are tangible in nature, it is quite clear and obvious that with every movement of goods, the taxes should also move, be it in form of outward tax or be it in form of input tax credit reversal, whatever be the case. But in terms of services, because the inherent challenge is that because services are intangible in nature, hence that is why it is quite difficult at the outset or at the first inception to identify as to where the services have been consumed and vis-a-vis whether the tax is also moved along with that consumption or not. Now, with this background, if you take a situation, let's say, in a hypothetical situation, but something which is quite relevant on the ground, let's say an entity which has a pan-India presence, it has a head office in Bombay, and let's say it has two factories, one in Kolkata and one in Noida. Let's say that factory in Bombay enters into a contract for receipt of some services with a supplier which is based in Jaipur. So now practically what would happen where the supplier who's sitting in Jaipur, who is in conversation with the head office which is there in Bombay, it confirms the rate and the nature of service, and the purchase order and everything is actually raised by the Bombay head office upon the supplier of services sitting in Jaipur. But the actual delivery of services takes place at the Kolkata branch and the Noida branch of that particular company. But because the communication and everything else has happened with the supplier who is sitting in Jaipur with the head office which is there in Bombay, the invoice is raised on the Bombay, but the delivery is being done at Jaipur. Now, mind you, we are not talking about a situation where it's a case of supply of service, a supply of goods, but it's a case where there is a supply of services. You can take any example, be it insurance, be it security services, be it software licenses, be it banking services. Now, in all these cases, if you would go back and look into it, these red lines which I have drawn in the presentation, you could see that these red lines is actually bifurcating the whole transaction into four separate states. Supplier in Rajasthan, the head office who is communicating is in Maharashtra, and the recipient of the actually beneficiary of the services, one in West Bengal and one in Uttar Pradesh. And hence that in this background, it becomes important to understand that if we go back to the larger question that GST being a destination based consumption tax, if the invoice is raised by the supplier only at the Bombay office, and subsequently just because that Bombay office is part of a larger company which only has GST registrations in 3 different states, if the invoicing is not done actually with the consumption of services, the taxes would not move. And in this background, we were always grappling about as to what needs to be done when a situation like this comes up. And up till 31st March 2025, all those who are aware about the basics of GST, they would have heard these two terms called input service distributor or cross charge. And that's where it would have come. So there are two ways to basically pass on that input tax credit in the previous example, which I had just quoted, which is available in the Bombay office, to pass on that credit to the Calcutta factory, the Kolkata factory or the Noida factory. through ISD or cross charge. And that's where now the whole fulcrum of the conversation basically depends as to this versus issue which was there, which was not settled, which had a lot of divergent views available both at the industry side of it, at the revenue side of it. Well, going forward, be it in form of a mandatory compliance or otherwise, it appears that now we are going to have some clarity, but that clarity is coming on the cost of having an additional compliance of input service distributor that needs to be done. So again, we go to the specific nitty-gritties of the compliances. With ISD, it is always very relevant to look into the concept, the parallel concept of cross charge, which is there, and to understand what is difference between the term cross charge and input service distributor, and whether both of them can coexist, or is it now that one of the concept will become irrelevant or outdated, or is it so that actually both of them are conceptually separate concepts, and through because on the basis of convenience or because of the basis of some relaxations which were given by way of circulars by the government in the previous periods, we were trying to basically look into them as an alternate to each other. What is cross charge? Well, now this cross charge as a term, it does not have any definition in the GST statute book or the rules or otherwise. It's a prevalent popular term which we understand when there is a concept of a deemed supply which is being made by a head office or a centralized office to its distinct entities. When we say distinct entities, we actually mean it in a technical language called as a distinct person defined under section 25 of the Act, and where we say that any person under a same PAN which has multiple GST registrations. So wherever there is a deemed supply which is taking place from the head office or the centralized office to its branches or the factories or warehouses, whatever it is under same PAN, then to that concept we call it as a cross charge. Vis-a-vis, if you compare this with ISD, ISD as such is basically an office which is a pass-through office, which is receiving invoices from an outside supplier of services, and its job is to actually receive the invoices on behalf of its other branches across India, or maybe in same state but different GST number, and to pass on that credit to the relevant recipient depending upon a specific logical formula which is given in the law. So if you look at it, cross charge as a concept is it's a charge of a supply. That means it is coming from the levy provisions, whereas ISD as a concept is a pass-through where it is receiving an invoice from an outside supplier, and whatever GST is involved in it is passed through it passes through to the relevant recipient where actually consumption is of that particular service has happened. Now, then what difference it is going to make? Again, the second bullet point which is there to understand is cross charge. It is understood that head office where it is involved itself is making an outward supply, then we would call it as a cross charge or a deemed supply. So that means we are talking about all internal transactions which are taking place at the head office, because in GST by way of a deeming fiction we understand that every GST number is a separate person for the purpose of GST, and because it's a separate person, then that head office as a deemed person has supplied some services to its respective branches, and for that internal activity which has taken place we are doing a cross charge. Whereas when you talk about ISD itself is not doing any activity. There is no internal transaction as such which ISD is doing. But as we explained that it's just a pass-through. So through that pass-through from an outward supplier perspective, an outward supply coming from an outside supplier to the ISD is being passed through a mechanism to the various recipients. Cross charge as a concept we understand is because it's a levy provision, it's part of a levy provision. It is applicable both for supply of goods or supply of services, whereas ISD particularly is only applicable and restricted in respect of services. It is not applicable per se on supply of goods. So on a broader perspective, if you understand, these are three basic differences between cross charge and ISD. Now, if you look at the legal definition, we have a definition of ISD under section 2 subsection 61, which was amended last year in Finance Act 2024. And then in this year in Finance Bill 2025, there was a slight correction which was required in the definition which was done. where ISD, if you read the definition, we'll understand. It also explains about, we'll go into the detail of the definition in a while, but it also explains about something as an office of a supplier of goods or services, receiving inward services, and those services which are on behalf of its recipient, it is passing on those services through mechanism of to its ISD to its recipient. Whereas cross charge, as I explained, there is no definition of cross charge. This terminology you would not find in the law, but yes, this terminology is arising from a legal deeming provision of taxability arising Schedule 1 to Section 7 of the CGST Act, which explains the scope of supply, where you would read deemed supplies, and in that deemed supplies we have entry 2, which talks about supply of goods or services between the distinct persons. Now, so in this background, as I explained, 2-3 questions which should come at the outset: whether these concepts are overlapping. Well, GST Council, being the constitutional body which has the whole responsibility of basically recommending any amendment in terms of the provisions of the law or the procedures, everything that passes through GST Council in its 35th meeting in June 2019 tried to basically solve this mystery, and they came out with a draft circular. However, that draft circular, though it came out in the public domain, but it did not see the light of the day and it was never implemented. So that was the first attempt where, through that draft circular, some insight as to what discussion had taken place in the GST Council was tried to be given, but it did not basically see, it did not come alive. And then, because it did not happen, but that draft circular was there in the public domain, so it kind of influenced the thought process again, both at the industry side and also at the revenue side of it. And there were divergent practices which are being basically done across the board, again, both at the revenue side and the industry side. We have advanced rulings which give divergent views, where some of them are saying that cross charge is optional, where some of them say that ISD is mandatory, where some of them say that both needs to be done. And there was a situation of total chaos because of that what needs to be done. Then in 50th GST Council meeting 2 years back in July 2023, Council deliberated upon this issue, and they came out with a circular by saying that ISD is optional. And in fact, they did not just say ISD is optional. To an extent, they would also said that cross charge is also optional. So that circular, in fact, became kind of a pivotal, it gained pivotal importance for all the chaos which was there on the ground before the issuance of that circular. And that circular kind of said that ultimately, at the end of the day, if let's say, if you do a cross charge also, but if your recipient is eligible for full input tax credit, then cross charge is also optional. And ISD, any which way, the manner in which it is written currently in the law, it's optional. But with this, then a subsequent amendment has been made, and now ISD has been made mandatory from 1/4/2025. Now, before we go there, just for a background for all those who are saying that up till now, was there a requirement or anything of that sort? So this circular number 199 dated 17th of July 2023, arising from the 50th GST Council meeting, is quite important. Three broader points which it clearly explains in that, which has been explained in that circular, is that ISD is not mandatory, it is optional. Second, it has been said if the distinct person is entitled for full input tax credit, then cross charge is also optional. And third, which is very important, because of which cross charge today has gained more popularity than ISD, is that the employee cost need not be included for the purpose of cross charge, irrespective of the fact that whether recipient is eligible for full input tax credit or not eligible for full input tax credit. And because of this circular, a situation arose where somebody who had neither done cross charge nor ISD, they were saved, and somebody who were basically thinking of doing what compliance needs to be done, they tilted towards doing a cross charge, because for ISD compliances, a separate registration is required to be taken. This brings us to the concept where we understand that now we are talking about from a perspective where I have multi GST registrations across India. That is more than one registration, where one of my office is a head office or a centralized office or a registered office. And that head office is kind of incurring two types of cost. One is an internal cost and second is an external cost. Now, if I try to basically write them down on the board, probably I'll be able to write all this what you see on your screen. In terms of internal cost, which a head office would have in its trial balance, it is going to be accounting services, IT cost, CEO, CFO, manpower cost, a centralized compliance team, probably in majority of the cases in terms of GST or other tax compliances sitting at the head office. The HR services generally are again centralized. So wherever the operations are centralized, wherever the SOPs are there, some of the activities which head office is going to do, all of these are internally generated costs, where manpower itself is engaged in executing all these types of functions. Now that function, mind you, is for the entity as a whole, but the execution of it, the cost booking of it, the necessary decisions in regard of this is taken by actually the head office. Whereas if you look at it, head office does not only have an internal cost, it also has quite an external cost where it engages with a lot of vendors. Some of those vendors who are actually supplying services to the head office only, whereas some of the vendors, like in the previous example which we saw, where the supply or the actual delivery of goods or services is being done at separate locations of that particular entity across India, but all the communication in terms of how it needs to be done, what needs to be done, and what price needs to be done is basically done at the head office only. And in fact, in majority of the cases, the invoicing and everything is done to the head office also. Now, so for internal, as of now, we will understand that manpower is involved. For external, as it is inward supplies which you are receiving, there can be possibility where it is exclusively for my branch situated at other GST number under same PAN, or it is only for my head office which is actually receiving the service and also having a conversation with the vendor, or it can be called as a common service. And that's where this word common services comes in, where I have a common cost sitting in the trial balance in my head office. And that common cost, I'm trying to find out whether I need to keep it here or I need to give it to somebody else outside. Again, why ISD is less popular and why we are discussing about it, because of cross charge. As I explained, that cross charge is important. What is cross charge which is taking place? And mind you, with 1/4/2025, it is not the case that just because ISD is becoming mandatory, cross charge has become optional. Conceptually, as explained earlier also, both of them work on a different concept altogether. Cross charge as a concept is actually part of a levy. It's a deemed supply which is being done by one distinct person for another distinct person. And if you look at it from an accounting perspective, what basically is happening in this case is that I have a head office which is receiving goods and services at its own place, wherever geographically it is located. It is consuming there, and that head office, by consuming those goods or services, sometimes only goods, sometimes only services, sometimes a combination of both, and by incurring the physical and the mental and otherwise cost of the manpower, that is the human resource cost there, is providing a support function to its distinct registrations of GST across India, which can be in form of factory, warehouse, godown, or whatsoever. So basically, the color of the outwards, the externally generated cost is getting converted by way of a consumption. And because that consumption is taking place at the head office only, by utilization of the intellect of the human resource sitting at the head office, it's kind of a support activity which is being done by the head office for its branches. For example, let's say the consolidated HR function, the consolidated finance function, the consolidated legal compliances function, all of that, it may include an outside supplier, but the head office is sitting there applying it's as its core function, and then giving it as a support service to a distinct person. This has been, on a conservative side, treated as a deemed supply by head office to its branches, covered in entry 2 to the schedule 1. And for that, we are doing a cross charge today. Okay. Now, when we talk about we are doing a cross charge, it's basically a billing which is being done by the head office to its branches, factories, depots, divisions, warehouses, and whatnot. The moot question, which has still not been answered anywhere today, before the matters are pending before the honorable high courts, though the issue has come up before various advanced ruling authorities as to what needs to be done in cross charge, what is the periphery of cross charge, to what extent I would understand that there is a supply which has happened from head office to branches. Today we do not have answers to this, but though because we do not have answers to this, we have circular number 199. And because circular number 199 says that employee cost, that is the manpower cost, need not be included when you're billing for a deemed supply from head office to branches, practically on the ground all of us are understanding, so that means it's very clear, let me take out all my human resource cost, which is any which way not leviable to GST, because there is no GST on salaries. Then whatever is left with me is actually cost which is coming from an outside supplier. So wherever I'm getting an input tax credit of it, I will take the credit of it here and then do a cross charge as a support service. And kind of circular number 199 says if you have done it and the other recipient is eligible for credit, then there is no problem. It is absolutely all right. But the point to ponder really in all these cases to understand is whether allocation of cost is actually a supply. Is this nothing else but allocation of cost? Or is there really a supply which has taken place from the head office to the branches? Or just merely an activity as a head office within branches can be treated as a supply? Now, because I said there is no precedence available, if you would look at it from an outside perspective, that is where we have a similar sort of a law across the globe, we will find that Canadian GST draws its parallel from the Indian GST. Rather, Canadian GST was implemented before the Indian GST, where they also have dual GST. And they are exactly on the similar issue, just like we have entry 2 to schedule 1. They have section 220 of the Canadian Excise Tax Act, where the similar provisions like deemed supply, which we have in entry 2, they have similar provision which says that if there is a supply which is taking place between two permanent establishments, then that shall be treated as a deemed supply. So in this very particular judgment, that is State Farm ET versus the Queen, the issue which came up way back in 2003, the question was that just because there is a cost allocation taking place, whether on that cost allocation a cross charge needs to be done or not. And there the court took a view by saying that just because in the law it has been mentioned that they, by fiction of law, these are two separate persons, until unless a specific activity is identified as to what has been the activity which has been done by one permanent establishment for another permanent establishment, cost allocation would not be subjected to GST under cross charge. Again, I am saying this is just a judgment coming from from a outside India Canadian GST, having no only we can see only a persuasive value, no binding value in India, but at least we get an idea and a sense of it that just because the cost allocation is taking place, cross charge is not required to be done. Now, having said that and having been done, and to understand that yes, it has a legal consequence even if you do it, now we deep down into ISD. So this background was important to understand because, as I explained, cross charge is still coexisting. It is not going away, and hence that is why for every transaction to be done to decide whether I have to cross charge or do ISD or not to do both or to do both, we have to understand from a point of view of it as to from what point of view you're looking at it. Now let's go back to ISD, that is, which is being made applicable mandatory from 1st of April 2025. First of all, ISD as a concept is not new to India. In fact, for all those who are not aware, ISD has existed prior to GST in India. It was introduced way back in 2005 during the excise times, where just for the purpose of when the service tax was there and a central excise law was there separately. And from ModVat to SENVAT, we had transitioned into there because the credit of services could be used for payment of excise duty. There, in those cases, the concept was brought in that you can have an ISD registration, an ISD as an office which is receiving the invoices for the purpose of distribution for various excise and service tax registration which one has under the same plan. Almost similar sort of concept transition into GST from 1/7/2017. The only difference that prior to 1/4/2025, ISD was not mandatory. In fact, in the pre-GST regime under the excise and service tax regime, there are plenty of judgments which have said that ISD is only procedural in nature, and the credit, if it has not been distributed through ISD, is still in that case, it is conceptually absolutely okay. We have a High Court judgment in case of Dawson Limited, which talks about a similar concept. However, that not being the case now, going forward from 1/4/2025, if you now look into it, that what are the relevant provisions which we have to do. So as we discussed that in the GST Council meeting 53rd and 55th specifically, you will find a lot of discussion about ISD as to why it needs to be made mandatory. We have definition of input service distributor under section 2 subsection 61, and the substantive provisions are contained in section 20 and section 21. The procedural law related to ISD is given in Rule 39 and Rule 54. And all of us know we have an ISD return which is called as GSTR 6. We have 4 separate circulars under which you would find mention about the concept of ISD, its applicability, mandatory, not mandatory, also about the recovery of in irregularly distributed credit. Now, what is the definition of ISD? What change has happened because of which there has been a trigger to say that it is mandatory for 1/4/2025? You will see 3 definitions on your screen. SENVAT definition under SENVAT credit rules, definition under CGST Act 2017 prior to 1/4/25, and then definition which is going to be applicable from 1/4/25. Now, in the prior definition, that is up till 31st March 2025, nowhere the definition refers to ISD being a mandatory concept. It says only an office of a supplier of goods or services which receives the tax invoices. And if it is receiving tax invoices from an outside supplier, then if it is issuing an invoice in a specified format for the purpose of distributing the credit, then it is called as ISD. So that means if I'm receiving if I'm receiving invoices from a third-party supplier, and if I'm not issuing an ISD invoice in a prescribed format, then in that case, I would not be called as ISD. If I'm not called as ISD, I need not take a registration. Now, when you read the definition, the relevant part of the definition, which kind of gives it a mandatory character, is an input service distributor, which is again an office of a supplier of goods or services, receiving invoices, including the concept of tax payment under reverse charge, again, which we would discuss. The relevant part is for and on behalf of a distinct person, and that's relevant. So if I'm receiving any invoice for and on behalf of my distinct person means my other GST registration under the same PAN, then it is my liability to actually distribute that input tax credit. So you would find the words liable to distribute missing in the earlier definitions. Now that we have that concept inbuilt in the definition only, 2 things that an ISD needs to determine: whether it is receiving invoices for services which are for and on behalf of a distinct person. And if that is taking place, then in that case, it is its liability to actually take a ISD registration and distribute that credit in a specified format. So what is the scope of this for and on behalf is going to be very important. And again, the brief discussion which we had regarding cross charge would again come into picture here to understand the scope of it. Okay. Now, when you would look into the definition, as I said, it means office of a supplier receiving of goods services, receiving tax invoices, including in respect of services on which tax is payable under reverse charge, which is for and on behalf of a distinct person, and liability to distribute. When you look into this 4 concept, you understand that it refers to one important word, which is called as what is supplier. We have a definition of supplier given in the law 2105. Supplier means any person who is supplying goods or services. So that means if I am, let's say, engaged in the business of manufacturing goods and selling it, but if, let's say, I have an office where it is receiving invoices and I have multiple GST registration, then in that case, that office of which is receiving services from an outside supplier would be called as an ISD. Interestingly, the question which comes while discussing this is that whether the recipient of service, if let's say an outside supplier, like for example, all of us as chartered accountants, when we are giving auditing services to our clients, and let's say that client has an ISD registration upon which we are raising our invoice, then in that case, whether the recipient of that credit will be the ISD or the person to whom the credit is ultimately going to be distributed. Well, the answer to that is somewhere hidden in Rule 39, where when we read Rule 39, Rule 39 says that recipient of credit in context of ISD means the person to whom the credit is distributed by ISD. Specifically, it means that though ISD may be making payment to the outside supplier, though the contractual understanding may be between the GST registration as ISD and the outside supplier, but for the purpose of input tax credit determination and the compliances in respect of Section 16 of input tax credit, the recipient of the credit will not be ISD, but the recipient of credit is going to be the person to whom the credit is distributed. So this as a concept slightly explains that what is the meaning of or scope of ISD. And when we look at it, we can understand that ISD is neither the supplier nor the recipient of any service. And this concept, when we understand it's only a pass-through which has to mandatorily take a separate registration, and it is solely meant for the purpose of availing the credit and distributing it to its distinct person on the basis of a specific formula. In fact, it cannot distribute the credit to its holding company or subsidiary company or the group companies. So that means anything which is beyond my PAN, that ISD cannot distribute the credit beyond the registration which are outside the PAN. So the sister concerns related parties, this ISD concept may not work. Where ISD is going to be mandatory. So around you have to look into all those cases where an entity under a same PAN, it has different factories, depots, warehouses, retail outlets, branches, divisions, service outlets, SEZ units, EOU units, you may name it, whatever under a PAN. If I have a separate registration under any type of a commercial arrangement, that would become my distinct person. And if I have it, and if I have an office which is receiving services, then there the concept of ISD is going to be mandatory. Now, because it is going to be mandatory, this has always been a part of the statute book under Section 24 that ISD has to take a compulsory registration. The only difference was under the definition of ISD up till 31st March, that compulsion itself was not there in the definition whether I'll be called as an ISD or not. But now from 1/4/25, as we just read, if I'm receiving services on or behalf of my distinct person, then it becomes my liability to distribute it. I fall in the definition of ISD, and because of that, I have to take a separate registration altogether. Now, what are the nature of transactions which are covered here? This is quite important, specifically in today's context when you're looking into the compliance that needs to be done in terms of ISD, that what are those transactions which would be covered? How do I have to structure it? And then what do I have to do on the ground to procedurally look into that aspect? Well, first of all, as we explained, and the name also suggests, it is input service distributor. So it is not applicable for invoices for supply of goods or supply of inputs or capital goods being made by being made by an outside supplier. Now, in the past, what basically we have experienced is that there is no check on the GST portal that somebody who is supplying goods, he may raise an invoice on an ISD registration. There is no check on the GST portal. And if the ISD is not vigilant enough and it distributes that credit of goods through its ISD registration, then that is not proper. That's in non-compliance under Section 20 and 21 of the Act. And that may lead to recovery of that credit, which cannot be claimed again. So it needs to be absolutely made very clear that all the supplies of services, which starts with HSN code 99, anything between the HSN code 1 to 98, for that credit cannot be distributed through ISD. That's the first checkpoint that needs to be understood. Second, in case of services also, is there something that the credit of these services I can distribute through ISD and this I cannot distribute through ISD? For this, go back to the earlier discussion which we had 10 minutes back regarding what needs to be done under cross-charge and what need not be done under cross-charge. And as we understood that cross-charge, when we do from a head office to its branches, cross-charge as a concept is to be understood that where it is receiving services, it may not receive a service, but these are internally generated costs which are there with the aid of an outside service supplier also. And those internally generated activities are called as a support activity or a support function or a support supply made by the head office to the branches. And that's where we would do a cross charge as a deemed supply. So for internally generated services where head office itself is putting an effort, for that cross charge will continue. For externally generated services where the head office need not do any activity, but it is only a pass through, that will actually route through ISD. So that in that sense, a bifurcation of the trial balance needs to be done at the head office level to identify what are those activities which are externally generated, which is for the benefit of the distinct person, which are actually received as a distinct person, and head office itself is not basically doing any activity there. Okay. With this, we go to the draft circular which we referred to that in 2019, which was brought in the public domain, just to basically give a brief idea what would be covered in the scope. Now, this is a diagram which was there in that draft circular only, where they refer to a head office, they refer to two branches, and they said that whatever input services are procured by head office, they named it at IS1. Then from head office to branches, any services given, they referred it to as C2 and C1. So they said services generated in head office, services generated in head office C1 and C2, and then services given by branch 1 to branch 2, they named it as BO1 and BO2. Now, what basically the circular said that only in respect of IS1, the services which are procured by head office but not consumed by head office, for that the ISD mechanism would be applicable. And for all other transactions, ISD would not be applicable, but cross charge is going to be mandatory. Now, if you translate that into example, what is going to be the example? The example at the outset can be, let's say the head office entered into a centralized security contract where there are security personnel at various branches across India, but the invoice by the security agency has been issued upon the head office. There, in that case, it is a case fit for ISD where the security agency should now, going forward from 1/4/25, raise invoice on the ISD registration of the head office, and then head office has to distribute that credit on the basis of the formula which is given under the rule. But let's say there is some admin cost, some finance related cost, some tech maintenance cost. There is a tech maintenance team sitting at the head office. There is a centralized HR team sitting at the head office, centralized admin team sitting at the head office. For all these which are internally generated activities, even if let's say an external service is procured by the head office, that need not be routed through ISD. In fact, that should not form part of the ISD. But for that, a cross charge needs to be done as a support service by the head office to the branches, subject to the benefits which are given in circular number 199, which we just referred to. Those benefits or those relaxations, they still continue. If somebody wants to avail them, they may do so. Otherwise, in all other cases, a cross charge kind of a scenario would be applicable for this admin, HR, finance related activities. So first question which would come, I think, across India on a plain reading of it, an auditing fee which is being raised on a multi GST registration by all of us chartered accountants, whether that should be part of a cross charge or whether that should be part of an ISD. Again, whether that should be part of cross charge or not is something which probably we would park it for some time. But clearly, to my understanding, that should not form part of your ISD registration or ISD compliance. Reason being that auditing services are actually procured by head office, and those services are consumed at the head office only. The benefit of that service may be for the complete organization as a whole. But think about a situation when you when you take up a statutory audit assignment, and let's say for a client which has factory in two different states, you may visit the factory, but ultimately you are not engaging yourself with any of the personnel or any of the resources which are there at the factories. Your interaction is limited to the central compliance team or the finance team or the accounts team. You're giving your report to them, you're answering to them, you're giving a service to them, and for them, they are the face, they are the single point of contact, and to them the services are given. Head office in turn actually receives your service, makes it part of their centralized compliance cost or the finance cost or the accounting cost. And then if they have this concept of appropriating it, they may do a cost allocation of it to the factories, or they may not do a cost allocation to the factory, which is an internal concept. But this would not be a case where ISD should be applicable. Vis-a-vis, compare this to a case where software licenses are there. where a software company which has identified the licenses of ERP that are required to be used at different locations, the number of licenses are absolutely clear, where those licenses are going to be used, that is absolutely very clear. If the invoice of that software license is centrally procured by the head office, this would be a case which will be covered under the ISD, for which ISD compliance needs to be done. So you may have a situation where you have all these examples as a cost where GST is applicable sitting in the trial balance of the head office. Advertisement, marketing, technical know-how, delivery vehicle repairs, AMC charges, software, sales promotion, royalty, professional fees, conference, staff insurance. Now, one may say all services which I'm receiving in the head office going forward tomorrow, I will do an ISD compliance. But before you do so, go back to the ISD definition, read those words which we had highlighted in red color, which is for and on behalf of the distinct person. Then there is a liability to distribute. So whether all these have been for and on behalf of the distinct person or not, that understanding you need to develop. Probably some of the examples where on the first look you would be able to identify that they should be covered under ISD is, like I said, security services, GTA related expenses if they are centrally incurred, consolidated insurance policy if that is being taken at the central head office level, software licenses taken at the head office level, centralized procurement for travel and hotel services, where the centralized payment is done by the head office for all these travel related across India, or whatever it for the sales team or marketing team, and bank expenses, specifically bank charges, bank guarantees, which can be for a specific branch, but they have a centralized banking team sitting there. For all these, ISD compliance would be mandatory in my understanding. So it has to be a restrictive compliance. It cannot be unrestrictive. Again, by saying, because ISD per se as a definition, it talks about for and on behalf of the distinct person. Now, after identification, what will happen? Once I'll do an identification, an ISD as a separate registration, when it will be done, it will has to basically go through that process of filing GSTR6. We'll go to return in a while. But then it is going to receive invoices where ISD registration will be mentioned by the outside supplier. Now, what are the type of inward supplies of services where ISD is going to take the credit? It's a regular outward supply made by a service supplier to the ISD. Debit notes issued by the supplier to an ISD, again for the services only. A unique case in respect of transfer of credit by a regular GST number under the same PAN to ISD. Mind you, it's a reverse transfer which is taking place, where a regular GST number of the PAN has received an invoice which is not only attributable to that particular registration but attributable to multiple GST registrations. So rather than it itself discharging an ISD function, it has to actually transfer that credit by issuing a specific invoice under Rule 54(1) capital A clause A to an ISD. So that ISD is going to take that credit, and also a self invoice under which the credit needs to be basically transferred, that is reverse charge. So up till now, before 1/4/25, there was no clear mention whether ISD can actually claim credit under reverse charge and pass it on. But now with the change in definition, it has been specifically included that in respect of reverse charge also, if it is for the distinct person, then ISD is going to receive it. And after receiving it, ISD is going to distribute it. How it is going to receive is going to be quite interesting, and we'll talk about it. So these are 4 different sources from where ISD is going to receive the credit in its ISD registration. And from that, it is going to attribute that credit if that is on a transaction level. It's not on a consolidated level. On a transaction level, for each transaction, ISD has to identify whether it is applicable for a specific branch. Then it will attribute directly to that specific branch by raising an ISD invoice. If it is attributable to more than one branch, then it will give it to the multiple branches or two branches. And if not, then in that case, there is going to be a turnover-based attribution that needs to be done. How distribution will take place? Distribution is going to take place wherever an ISD receives an integrated tax as an inward supply from the supplier of services, it will distribute as IGST, CGST as CGST, and SGST as SGST. If both ISD and the registration to whom the credit has to be distributed are in the same state. If the ISD is in one state and the credit needs to be distributed to a recipient which is in another state, then IGST, CGST, and SGST will be distributed as IGST only, which is quite understandable, because if I am in Rajasthan as an ISD and my recipient to whom I'm distributing the credit is in another state, let's say Gujarat, then in that case it needs to be ensured that Gujarat receives an ISD invoice from me as IGST, otherwise it won't be able to claim the credit. Why there is an asterisk mark? Because there is when you read the section and rule, there is a mismatch. Section says that credit of IGST can be distributed as IGST or CGST in case of an intrastate transaction, and the credit of CGST can be distributed as IGST also. However, when you read rule says credit of C has to be distributed as C and credit of I needs to be distributed as I. So section allows this interchange, but rule does not allow. Because we are at the compliance stage as of now and we are not litigating anything, it's better to be safe rather than to really litigate. And hence, a precautionary step should be taken that credit is distributed the manner in which it is mentioned in the rules, though it may not be completely consistent with the manner in which the section is written, but it is just a way of avoiding the litigation. It should not result into any additional cost to the person to whom the credit is being distributed. Now, what are the conditions that needs to be followed? This is quite important in terms of ISD, that if an ISD is claiming a credit and then it is passing it on, these are certain conditions which are mentioned in section 20, subsection 2, read with rule 39, that needs to be followed. The conditions are that ISD can only distribute credit through an ISD invoice. So there is, under rule 54, there is a specific contents of the format, not the format, but the contents of the invoice. ISD invoice is given, that needs to be followed by the ISD. Then the credit that needs to be distributed should not exceed the credit available. And credit available, as we understand, is the credit which is coming in my GSTR 6A. So whatever credit is coming, I cannot distribute more than that. Third, ISD, again, to understand, is just not a mechanism to distribute eligible credit. If I have an ineligible credit, like for example, let's say my head office has done a centralized contract for renting a motor vehicle for all my branches across India. And let's say I am not entitled to claim the credit of those motor vehicle renting because it is blocked under section 17.5. Then that ISD has to raise two separate invoices, one for my eligible credit for distribution of it and one for credit of ineligible distribution of ineligible credit. And the ineligible credits will actually go to my respective recipient state, and recipient state is then going to reverse that in GSTR 3B under permanent reversal. Whereas for eligible credit, once it will be distributed through the relevant recipient state, they will claim that credit and they will not reverse it. So that's the concept which is there. It is applicable for both recipient who are registered for both eligible and ineligible. Next, if the credit is attributable to one specific registration, it needs to be transferred to that specific registration only. I can't do a case where on the face of the invoice of the supplier of services when received by an ISD, it is known that this credit is attributable to my specific branch. For example, let's say some lawyer has given a service for my specific branch in Chennai, and I am in Bombay where I have an ISD registration. It is my duty and it is mandatory for me under the provisions of the law that I take this credit and I distribute that credit to my Chennai registration, irrespective whether my Chennai registration would be able to use it, not use it, avail it, not consume it. That is not the criteria here. But I cannot distribute it on the basis of a turnover. So on a transaction to transaction level, it needs to be identified whether it is a specified credit for a specific branch or two branches, or it can be tantamount or called as a common credit. Wherever it is a common credit, that needs to be distributed on a pro rata basis. Pro rata basis is basically the turnover of the individual unit divided by the aggregate total turnover of the particular PAN as a whole. We call it as the aggregate turnover in a state. And the distribution needs to be done on a monthly basis. That means the invoice, if there is a transfer needs to happen, it has to be done on a monthly basis. The returns are required to be filed on a monthly basis. Even if there is a nil return, that nil return is required to be filed by ISD. There is one more concept which is there in the rule, that credit needs to be distributed in the same month. Now, the same month distribution credit is a point where in some pockets of the country, the disputes have arose. What do you understand by same month? Same month is the month where it is appearing in my table 6A. or same month is the month where ISD has actually received the invoice. Now, when you look at it practically, it should be the month in which where ISD has received both the physical invoice or where it has accounted for in its books of account and the credit is also available in my 6A. But in some pockets, the understanding has been of the field formation officer that same month means the month in which it is appearing in my 6A, which may not be practical. It has led to, in some cases, it has led to litigation also. But the correct reading of this should be that the month in which where ISD has accounted for in the books of account and it is also there in my 6A, that would be called as the same month. In that case, the credit should be distributed and it should not be kept for distribution in the subsequent month. How will one identify the turnover when there is a common credit? For that, it says wherever recipient has a turnover in the previous financial year, then previous financial year turnover, that is the GST turnover, we take aggregate turnover in that particular state, that would be considered. So we will make a cumulation of the aggregate turnover of all the states or all the GST numbers of the previous financial year. We will total it and we will call it as a total turnover. And then on the pro rata basis of the each state, that will be distributed. If let's say some state does not have a turnover in the previous year, that was not into existence, it's a new registration, then the turnover of the previous quarter, if let's say a distribution needs to be done in the month of March, then if I have turnover for the period of October to December, then the period turnover of October to December needs to be taken for the purpose of determining the distribution that needs to be done. If I do not have a turnover of the previous quarter also, then that particular recipient will not receive any input tax credit by way of ISD. For them, the turnover is going to be zero. So that's the definition of a turnover, which is relevant for the purpose of distribution. When we go to documents, what are the various documents and returns? So as we explained that ISD has to distribute the credit on the basis of an ISD invoice that needs to be issued in compliance of Rule 54 sub Rule 1, which basically talks about certain requirements that its GST number of the recipient, an invoice separately for distribution of eligible credit, an invoice separately for ineligible credit. It is not mandatory on the ISD invoice to write the taxable value. What is mandatory on the ISD invoice to write the tax amount. But remember, in GSTR 6, when you file your return, it is mandatory to write the taxable value also. So it is not the case that you don't have to record the taxable value.
I'm really sorry to interrupt you between your presentations, but exceed the timeline.
Yeah, I'll just wind up I'll wind up in 3 minutes more.
Okay, sir. Thank you so much.
Started at 15, but I'll wind up in 3 minutes.
Okay, question answers poll is also there.
Okay, then I'll take last 2 minutes, then I'll end. Okay.
Thank you so much, sir.
So yeah, so the taxable value needs to be right in the GST returns, but it need not be right in GSTR 6, but it need not be right on the ISD invoice. Okay. The most challenging part in ISD compliance is ISD credit note. Why? Because just like an ISD has to distribute the credit on the invoice, if let's say subsequently supplier issues a credit note, that credit note also needs to be distributed in the proportion where the original credit was distributed. Remember, the credit note that will be issued by the ISD, it will not be distributed on the basis of current month's turnover, but it will be distributed on the basis if how was original credit distributed. And this record is going to be quite challenging, where somebody has to really ensure they put this in their system. This is a new concept, which probably some of us who have been doing ISD compliance, for them, this is going to be that they have to take care of it, because under ISD now RCM can also, the credit of RCM needs to be distributed. So what is there? Let's say a supplier has issued an invoice of 1,000 rupees. And it is applicable for both RCM also and other than RCM also, where my regular registration is receiving the credit, where ISD, where the credit invoice has not been raised on the ISD. So let's say supplier has issued an invoice of 1,000 plus 100 rupees on my regular registration. Now, what my regular registration will do, out of that, it will identify the credit which is relevant to it. So let's say in this case, the credit of 300 plus 30 was relevant to it. It will keep it with it. And the balance 700 plus 70, it will raise a specific invoice under 54(1)(a) to ISD. So now in this case, my regular registration is raising an invoice on ISD. My ISD will account for it, and ISD, on the basis of whatever formula is applicable, it will distribute that credit, let's say, to my 2 branches. If let's say it's 50-50 turnover is there for the sake of convenience. So then it will distribute that 50-50 to the 2 branches. and then 2 branches are going to take the credit in GST or 3B. Similar would be the case for RCM, because ISD cannot pay tax under RCM. So a regular registration will be taxed under RCM. Then they will raise invoice under 54(1)(a) to the ISD, and then ISD is going to take credit of it, and then ISD is going to distribute it through an ISD registration. ISD return is GSTR 6 that needs to be filed by 13th and it will be available on 14th. Last 1 minute I'll take, and then we'll go to the question answer session. ISD has to also distribute the credit to SEZs. So now we understand, if let's say under my same PAN I have an SEZ. The problem is, to an SEZ today we do not charge any tax. But now through an ISD, a credit would go through the SEZ, and then SEZ has to claim a refund of it. If SEZ is, let's say, has any other supplies, then it can use that credit. Otherwise, SEZ has to claim a refund of it. So this is going to be quite challenging for SEZs who are up till now not operating under through an ISD mechanism. They have to follow it. Mind you, under ISD, the recovery which is going to happen, if let's say there is a wrong distribution of credit, that will be done at the recipient end. So that means the assessment in respect of ISD will be done at the recipient end. If I am the ISD sitting in Rajasthan, if I have 10 recipients, that means 10 assessing officers are going to verify whether the distribution which has been done by Rajasthan is proper or not. And if they find it improper, be it more or less, whatever it is, then in that case, they will issue a show cause in their respective states. So that means the documentation in respect of ISD, that needs to be secured and saved for the 10 assessments that are going to take place. I think, so as a concept, I have explained what is ISD, what are the routine compliances. Because we have limited time, if there are any questions, I'll be happy to take one or those 2 questions. Thank you.
Thank you so much, yes, sir. Very insightful presentations on the ISD mechanism. Some question answers are there. Just a minute. One question is there. Whether the ISD invoices and self-invoices for RCM be by generation of electronic invoices from IRP portal or a simple supplier tax invoice?
Yes. So no, IRN is not applicable. IRP is not applicable for this. So it will be a regular invoice without any IRN.
Thank you, sir. One question is, that has been matter of extensive debate by the department is that case of cross-charge, the assessee branch for claiming ITC need to justify whether the service received by the branch through cross-charge invoice is actually consumed by branch or not. In this new era, when both cross-charge and ISD exist, how will assessee convince the department that service are actually used by branch or not in both ISD or cross-charge scenarios?
I think this we have explained in detail. For internally generated services, there has to be cross-charge. For external cost, where head office is not basically doing any activity, it's only a conduit. For that, ISD mechanism would be there. We took some examples around it. So I think this we have explained in detail.
Okay, sir. Thank you so much, sir.
Thank you so much.
So now our second speaker, CA Prakash Parwal, sir, from Jaipur. Prakash, sir, having experience span across four decades in domestic, corporate, and international taxation. He has been regularly appearing before Jaipur, Jodhpur, and Delhi branch of Income Tax Appellate Tribunal and before Interim Board of Settlement Commission. He has been in positions like Director Technical of Jaipur Tax Tribunal Bar Association and co-opted member of National Executive Committee of All India Federations Tax Practitioner. Has handled income tax searches and surveys matter and corporate taxation of various companies in public and private sector. He has been a regular speaker on budget talks, direct tax, accounting standard, and for capacity building program of the Indian revenue officials. So today we'll discuss new income tax bill 2025, transforming India's tax landscape. So CA Prakash Parwal, sir, welcoming in this webinar.
Thank you, madam. Before I start, I would like to know something from you. This is an unstructured learning program. Yes?
Yes, sir.
And I find that there are only 6 participants. Are there more in numbers?
Yes, sir. It's approximately 9. Yeah.
In my screen, these are only 6 participants. Acha, they are watching us on this webcast. So it is not appearing here.
It's just only team
Fine.
members.
Right.
Yes, sir.
So just I was looking at how means effective is the unstructured learning program that I wanted to say.
I can understand, sir.
So even at the institute level, the things goes as it goes on.
Yes, sir.
So let us start with our topic. The topic for the today's discussion is the new income tax bill. So what I would like to do is just give a back history of how the income tax has evolved and what new is now proposed in the income tax bill, and some of the important issues that we need to take into consideration because it is still at a very infant stage. If there is any suggestion, the CBDT has also come out with a portal where you can send your suggestion. Institute has also organized a meeting of all the zones where suggestions were sought, and that has been also represented to the CBDT or select committee, I don't know, but it has gone there also. So I think presentation is visible.
Yes, sir. Yes.
So let us talk something about the history of the Income Tax Act. In fact, this Income Tax Act was promulgated by the Britishers way back in 1860. But the first Income Tax Act was of 1922. Now, most of the persons or most of the professionals who are now present may not have dealt with Income Tax Act 1922. Then after 40 years, so it was Income Tax Act 1961. And the Income Tax Act 1961 has been amended nearly 65 times with more than 4,000 amendments. So with such a huge changes over a period of, say, from 61 to 2025, around 64 years has elapsed from the 1961 Act to 2025. But in between, there were efforts made to change the Income Tax Act 1961. And the first constructive effect was when P. Chidambaram was our finance minister, when this Direct Tax Code 2009 was introduced. It was in public domain, their discussion were made, but it did not see the light of the day. Then in 2019, a committee was formed to seek information or suggestion from the department and otherwise that what amendments are required in the Income Tax Act 1961 or a new Income Tax Act is to be taken into consideration. So those things went on. But for the first time, the finance minister in her budget speech on 23rd of July 2024, at that time she gave a hint of introducing a new income tax bill. And the exact wordings of the finance minister was that she is now announcing a comprehensive review of the Income Tax Act 1961. The purpose is to make the act concise, lucid, easy to read and understand. This will reduce dispute and litigation, thereby providing tax certainty to the taxpayers. It will also bring down the demand embroiled in litigation. It is proposed to be completed in 6 months. So in the budget speech of the last year, because of the elections, instead of February 2024, the final budget was presented on 23rd of July 2024. So in that budget speech, the finance minister stated that they would like to come out with a new bill which would be concise, lucid, and easy to read and understand it, and that exercise would be completed in 6 months. And yes, not in 6 months, but in this budget, which was presented on 1st of February 2024, she again mentioned that this new bill would be presented in next 7 days, and it would be clear and direct in text with close to half of the present law in terms of both chapters and words. That was what she stated in the budget speech. It would be simple to understand for the taxpayer and the tax administration, and it would lead to tax certainty and reduce litigation. So that was what she stated in the budget speech on 1st of February 2025. Then on 7th February 2025, this income tax bill 2025 was presented in the Lok Sabha, and it was tabled in the parliament on 13th February 2025, and then it came to the public domain. Now this bill, if passed by the parliament, after this parliament tabling in the parliament, then it was sent to a select committee constituting of, I think, more than 30 members. I think it is 33 members or so. So it is now before the parliamentary select committee where it would be debated. Suggestion has been sought, and after the deliberation, the final bill would be presented. And if it is passed in the parliament, this new income tax bill will become effective from 1st of April 2026. So that is the background under which this bill has been presented. Now, what is the intention behind presenting this bill? 3 intentions. Simplification of language is the first. Deleting obsolete and redundant provisions is the second. And reducing the litigation is the third. And the 3 core principle which has been the deriving force in making out this bill, they have tried to make it simple by textual and structural changes so as to have a improved clarity and coherence. There is no major policy changes for the reason that they want to ensure continuity and certainty in the tax laws. So whatever changes has been made in the budget 2025, which was presented on 1st February, the parliament is in session, and that would be passed in this session. So it would become act. So whatever changes has been made in the present finance bill, that has already been incorporated in this finance bill, in this income tax bill. So all those has been incorporated, and there is no major policy change so far as taxes are concerned. There is no modification of tax rates. So predictability has been preserved. Now, 3 approaches of this bill is to eliminate intricate language to enhance readability. अभी जो इनकम टैक्स एक्ट है उसमें प्रोविजो, फिर एक्सप्लेनेशन, फिर सेकंड प्रोविजो, थर्ड प्रोविजो. इफ वन लुक इनटू 1023C सेक्शन, देयर आर एज मेनी एज 24 प्रोविजो. तो उसको जो पढ़ना है वही एक बहुत कॉम्प्लिकेट और इंट्रिकेट हो जाता है. So they have tried to eliminate all those proviso and explanation. Now everything is in section and subsection. Then second step is to remove the redundant and repetitive provision for better navigation. And third is reorganizing the sections logically to facilitate the ease of reference. So these are the 3 approaches which is there in the present bill. Now, if we come to the structural changes, and if we compare with 1961 Act structure with 2025 bill structure, then the statistics are like this. The number of words which is used in 1961 Act is 5,12,000 words. In the bill 2025, the number has been reduced to almost half. It is 2,60,000 words. So far as chapters are concerned, from 47 chapters, it is reduced to 23 chapters. Number of sections, as such, if we go to the Income Tax Act 1961, the number are 298 sections. But within 298 sections, there are number of sections like A, B, C, D, E, F, G, H, like that. Even in section 10, there are as many as 48 subsections. 10.1, 10.2, like 10.47 and 10.48. So if we count them individually, the number of sections in the present act is 819 sections, which would be reduced to 536 section in the present bill. Now, lot of use has been made in the present bill by way of tabular representation and by using the formula. And therefore, in the present act, there are 18 tables, which is now increased to 57 tables. Formulas, there are 6 formula used in the present act. Now it is 46 formula which would be used in the 2025 bill. Number of schedules are 14, which would be increased to 16. But number of pages of the present act is 823 pages, which would be reduced to 622 pages in 2025 bill. So these are the structural changes. And because of all these structural changes, 1200 provisos, and 900 explanation that has been removed. And they have been incorporated by way of sections or subsections. So this is the overall structural change which has been made in the present bill. Now we would be discussing some of the important issues or concept which has been introduced in this 2025 bill. And the first conceptual change is about the assessment year. Hitherto, we are using the word previous year and assessment year. And it is a big confusion regarding the assessment year. So now this assessment year is replaced with the term tax year. And what is this tax year? This tax year is defined as per section 3 of the bill to mean a period of the 12-month period of the financial year commencing on 1st of April. So from 1st of April, it would start. But suppose a business is set up during the year, or if there is a source of income which has come to surface during the year, then it has been clarified that if the business is set up during the year, then it would start from the date of setting up of the business, but it would close on 31st of March. Similarly, if a new source of income has come, it would start from the date of its existence and would end at the end of the financial year. So this section 3 of the Income Tax Act, Income Tax Bill, that now defines the tax year. So it would now always start from 1st of April or the date of setting up of the business or the date when the new source comes into existence, but it would definitely end on 31st of March. So this is one major change which is been there. And with this introduction of the taxpayer, the two principle has been adopted. One is the tax year, which is a period for taxation. And this term will be referred in respect of all transaction in income for that period. But apart from tax year, there would be a financial year concept also, which is for the purpose of timelines for compliance on procedural issues. So wherever there is a filing of, say, any return or, for example, TDS return or any other information which is to be furnished to the department, it would be with reference to the financial year. So this is the first concept, new concept, which has been introduced in this bill. Now, another major changes is with reference to the taxation of charitable trust and institution. Now, we all know that presently the taxation of charitable trust and institutions is spread over number of sections. Starting from section 215, which is falling in chapter 1, then we have 1023C, then in chapter 3, Then we have section 11, 12, 12A, 12AA, 12AB, section 13. Then we have section 115BBC. So it is spread across the act. And then we have a proviso with relation to donation, which is in section 80G. Now, all these things has now been consolidated and simplified in one chapter. And this chapter is now in part B of chapter 17, titled as Special Provision for Registered Non-Profit Organization. So instead of using the word trust or institution, now the word is non-profit organization. So this new word is now coined in the entire income tax bill. So instead of charitable trust or institution, now it is the non-profit organization. So this is one important conceptual change in by way of using the word. The overall concept remains the same, but the nomenclature has been changed from charitable trust and institution. Now it is non-profit organization. And all those sections which were dealing with the charitable trust and institution is now grouped in a single chapter, which is chapter 17. So there it is grouped. Now it is also provided that this there is a concept of a registered non-profit organization. Now, registered non-profit organization is defined to mean that if any person is having a valid registration under the existing law, either under section 12AB or section 1023C, then it would be continued as such unless and until this registration has been cancelled. So whosoever is already registered under section 12AB or under section 1023C, they would continue to get the same benefit under the new concept of non-profit organization. They would be considered as a registered non-profit organization. Now, presently, if we look to the concept of registration of charitable trust and institution, then we have two sections. One is section 1023C. In 1023C, Roman 4, 4A, 5, and 6, there is a concept of approval. Whereas in section 12AB, there is a concept of registration. And for 80G, there is a concept of approval. Now, what is done in this new bill is that for registration of a non-profit organization, only it would be registration, not approval. So if you are under section 1023C institution, or if you are in section 12AB, so 12AB registration and 1023C approval, they have been merged to say that both sections are now merged into one and they would be considered as a registered non-profit organization. But so far as section 80G is concerned, the corresponding section in the new income tax bill would be section 354, where the term approval has been written. So this 12AB and 1023C, there is now proposed in section 332 of the new income tax bill, and the approval of 80G5 is now incorporated in section 354 of the new income tax bill. Now, some redundant provisions has been tried to be removed, and the two major changes which has been made is that there is presently a concept of capital gain taxation under section 11(1)(a) in the present Income Tax Act. Now, that has been done away with. And the reason for that is that in the present act, if a trust or institution or a non-profit organization dispose of any of the asset, any of the capital asset, and if that is reinvested either by way of an FDR or in purchase of any other capital asset, or even if it is kept in the bank account, then it is considered that capital gain has been utilized. There is a concept of application of income. So what has been thought in this bill is that there is no useful purpose for keeping section 11(1)(a), because if you have kept the proceeds of your capital asset in the bank account, if that is considered as utilization of the capital asset, then there is no need of this section, and therefore this section has been done away with in the new bill. Then we also have a explanation 1 to section 11. Suppose a trust or institution has earned any income at the fag end of the year, say on 25th of March, it has earned some income. Now that income, it is not utilized before 31st of March. But if the SSC makes a application before the assessing officer that I would utilize in the subsequent year because this income has accrued to me, has not received by me, then there is a concept of deemed application. So that concept of deemed application under explanation 1 to section 11, that has also been done away with. So these are the two major changes which has been made in this non-profit organization taxation. So if we look into the entirety of the changes, so what is the present provision? The present scheme is that different provisions of charitable trust and institutions are spread in different chapters. For example, in chapter 1, we have a definition of section of charitable trust or institution under section 215. Then in chapter 3, we have section 1023C, 11, 12, and 13. Then in chapter 6A, we have donation under section 80G. Then chapter 12A, if we have anonymous donation or like that, then there are two sections where it can be taxed. And chapter 22EB, which is if you have defaulted, then your accredited income can be brought to tax. So that is in chapter 12EB. Now all those things has been now proposed to be introduced in chapter 17B of this bill, where this would contain the entire procedure of registration, how income is to be calculated, what would be considered as commercial activity, what compliances are to be made, what would happen if there is a violation, what would be considered as violation, approval for donation, and interpretation. So entire interpretation of non-profit organization, even section 215 is now part of this interpretation clause. So whatever is interpretation, that is in the separate section in this chapter itself. So the overall concept is to replace trust, institution, university, educational institution, hospital, etc., which is used in the present act, by the word non-profit organization to remove confusion. All explanation and provision has been removed. Now tables has been made within the section for application for registration. Presently, if we go to the Income Tax Act section 12A small AC, then there is subclause 1, 2, 3, 4, 5, 6. So now that has been formulated in form of a table. So application for registration, there is a table. What would be the specified income and the tax year in which it would be taxable, that is also by way of a table. And computation of tax on accredited income, that is also by way of a table. And there is a minimum cross reference due to better restructuring, and the redundant provisions has been removed. So these are the overall changes which has been proposed in this bill. Now, if we look into the salary and house property head, that what are the changes there? So basically no changes, things remains the same, but the existing provisions and explanation have been integrated into the main provision for eliminating fragmentation and improving readability. And because of all these changes, the number of words which were used under the part salary has been reduced to 3,420 words from 4,401 words. And similarly, under the head income from house property, the number of words presently used is 1658 words, which is now reduced to 1177 words. So by all this restructuring, the number of words has been reduced. Now all the provisions relating to salary has been brought under the part salary, so that we are not to refer to the separate chapters for filing the return of income. The language has been made simpler. All crucial terminology like perquisite, profit in lieu of salary, standard deduction, they have been placed in separate sections. And the provisions of perquisite has been rewritten in a more structured and clear manner, and some of the provisions has been taken to rules. So this is how there is structural change in the salary and income from house property. Now, if we come to the profit and gains of business and profession, then the major changes is that the flow of section has been revised to improve coherence, create logical links, and ensure a smoother progression. Now, wherever there are similar sections, for example, presumptive taxation for resident and non-resident, so they have been merged to simplify the content, make it more concise, and consolidate all related scenarios in one place. Now, similar provisions for similar topics, such as deductions for employees' welfare, which was scattered across the chapters, that has been grouped together for easier understanding and compliance. And formula-based explanation have been added to clarify the complex concept, which was previously difficult to understand. For example, for the definition of written down value, section 43(6). So that has been now more lucidly tabulated in this present bill. Now, provisions involving multiple scenarios like determining actual cost, which was previously presented as proviso and explanation, that has been organized into a table. All provisions and explanation has been converted into subsections to eliminate ambiguity and ensure clarity. Now, redundant and already sunset provisions has been removed. For example, that investment allowance, so they are no longer in use. So all those provisions has been removed. Now, some of the provisions which are related to a single business segment, for example, this site restoration fund, tea development account, coffee development account, rubber development account, so they have been removed from the act and they have now been placed to a new schedule. And some of the procedural section has been transferred to the rules to reduce complexity and focus on the substance of the section. And because of all these effort, the word counts have reduced by more than half, and sections have decreased from 65 to 41. So that is the statistical figure which has been given because of the changes in this profit and gains of business and profession. Now, if we come to the deeming fictions, now presently we have all deeming fictions in section 68, 69A, 69, 69A, B, C, and 69D. And if we look to section 68, it talks about cash credit. So there is a lot of confusion amongst the general public that what it means, what is cash credit? If any amount is received in cash, then it is a cash credit, or it is all credit which is credited in the books of account, that is cash credit. So for a general person, the name suggests that if it is received in cash, then it is a cash credit. So now the corresponding section of 102, it has been named as unexplained credits. So better understandability and better readability. Now unexplained investment, it remains the same. Section 69 now replaced to section 103. Now section 69A, and section 69B, unexplained money, etc., and amount of investment not fully disclosed in the books of account. Now, these has been merged into a single section, section 104, as unexplained asset. And asset would include money, bullion, jewelry, virtual digital asset, or any other valuable article or thing. So asset is now separately defined in section 104 in the present bill. And instead of unexplained money or the amount of investment not disclosed, the single word is coined unexplained asset. So now we have unexplained credit, unexplained investment, and unexplained asset. Now, unexplained expenditure remains the same. And section 69D, which only talks of amount borrowed or repaid on hundi, now that has been enlarged to include negotiable instrument, hundis, etc. So apart from hundi, it can be negotiable instrument, hundis, or similar nature of word, because the word now used is etc. So these are the changes which is proposed in the deeming provisions of the Income Tax Act 1961 vis-a-vis Income Tax Bill 2025. Now coming to section 10, exemptions. Now, as I have already mentioned that in section 10, we have number of subsections, starting from subsection 1 to 47. Now, what has been done in the present bill is they have been tried to be incorporated by way of a schedule. So what is done is that presently we have around 140 clauses in section 10, providing exemption to different persons and incomes. So some sections give you exemption to a person and some are in relation to income. And within this section, there are number of clauses and explanation. And again, proviso to the explanation. So what has been done in the present bill is that all these provisions relating to exemptions has been incorporated into 6 different schedules relating to a specified category of taxpayers. So all exemption provision has now been shifted to 6 different schedules. Now the income which is eligible for exemption, one schedule, eligible person, and the applicable condition has been provided in different columns of the table under each of these schedule for ease of understanding. So even within the schedule, it has been reorganized in a tabular form. So if we look to that what are those schedules, then these exemptions has been placed in these 6 different schedules. So schedule 2 would be dealing with income from agriculture. Schedule 3, certain persons who are eligible for exemption, like the partners of the firm, HUF, so they have been placed in schedule 3. Schedule 4 is exemptions to non-resident. If a non-resident has any income, for example, an RE account interest, so that is now placed there in schedule 4. Now, schedule 5 is exemption to business trust, sovereign wealth fund, etc. Schedule 6 is for IFC unit, gift city units. And schedule 7 is persons exempt from tax. So wherever in section 10, certain exemption has been given to the persons, then that has been placed as a part of schedule 7. So in fact, section 10 is now incorporated in these 6 schedules. So if one is to look into the exemption provision, one has to go to this 6 schedule. So this is how it has been reorganized. Now, one important change which has been made is in the residential status. And the purpose of that change is basically to reduce the litigation, because one of the objective of this bill is to reduce the litigation also. So presently the residential status is defined in section 6 and a person is considered to be a resident of India if his stay in India is more than 182 days during a financial year, or if his stay is 365 days or more in India in the last 4 years, and at least 60 days in the current financial year, then he is considered to be a resident in India. But there is a proviso to this section, and it says that if a Indian citizen is leaving the country for the purpose of employment, then only first condition need to be checked whether his stay in India is 162 days or more in that financial year. So here the word used is for the purpose of employment. Now there is a lot of debate and dispute that what is the meaning of purpose of employment. Suppose a person has obtained a business visa, and in that business visa he has gone abroad. He made a trip there and returned back. Can it be said that he has gone out of India for the purpose of employment? So this purpose of employment is now changed to for employment. So because of the judicial interpretation of the purpose of employment, now what change has been made? The change is that instead of for the purpose of employment, it would be for employment outside India. So there has to be a positive action of employment outside India. Now you cannot travel outside India on a business visa to claim that you have gone outside India for the purpose of employment because you have a business visa. So the purpose here is the job seekers, self-employed individuals, freelancers and professionals may now fall outside the relaxed residency benefit. So that change has been made, which may affect a lot of persons who go out of India saying that it is for the purpose of employment, whereas actually it is not for the purpose of employment, but for a travel purpose or for a pleasure trip by obtaining a business visa. So this is an important change in order to reduce the litigation. Now in double taxation relief, now certain changes has been made by introducing this section 159(7) of the bill to make the things more clear. Now what is provided in this double taxation relief is presently, if there are provisions under the DTAA and also under the Income Tax Act, then whichever is more beneficial, that would apply to the concerned person. But there are some issues that some words are there in the Income Tax Act, but that word is not defined in DTAA, or there is a definition in DTAA, but it is not defined in the bill. Or if that word is defined in both the DTAA and the Income Tax Act, then what would prevail? So to clarify that, now there are four subsection which has been introduced in section 159(7). Now first is that if any term is used in the agreement and defined both in the agreement and the bill, then its meaning will be as provided in the agreement. So if a word has been used and defined in the agreement as also in the income tax bill or presently Income Tax Act, then the definition or meaning which is given in the agreement, that would prevail. But suppose if a term is used in the agreement but not defined in it, it has been used but not defined, but that has a definition in the act or in the bill, then it is clarified that it will have the meaning provided in the bill or in any explanation which is given to it by the central government, and the meaning will be applicable from the date of the agreement. So a word is used, but it is not defined in the DTAA, but there is a definition in the bill, or if the central government has come out with the definition by way of any circular, then the meaning given in the bill or by the CBDT circular, that would be given the meaning in the agreement also, and it would be applied from the date of the agreement. Now, the third situation is that if a term is used in the agreement and is neither defined in the agreement nor in the bill, then it will have the meaning given to it in any notification issued by the central government, and such meaning will be applicable from the date of the agreement. So if it is neither defined in agreement or in the bill, then whatever notification is issued by the central government, that would be applicable. And the fourth is, if any term is used in the agreement and is not defined in the agreement or in the bill or in any notification, it will have the meaning given in any act of the central government relating to taxes. And if there is no such meaning given in the act relating to taxes, then in any other law of the central government, and such meaning will be applicable from the date of the agreement. So wherever it has been defined in any other law, even if it is not in relation to taxes, if that word is used in the agreement but not defined in agreement or in the bill, then the meaning given in that other law would be applicable, and it would be applicable from the date of the agreement. So the purpose of this is to reduce litigation and provide certainty as to how any term is to be interpreted in the tax treaty situation. So these changes may have far-reaching effect when it actually comes to taxation of the non-resident entity. Now the next is the new tax regime. So far as new tax regime is concerned, presently this section 155 BAC, it is applicable only for individual and HUF. Now in this bill, this has been extended to association of person, body of individual, and artificial jurisdiction person also. So its scope has been enlarged. Other than this, if you want to opt out because it is a default scheme. So if you want not to be covered by this new regime, then you have an option to take yourself out of this new tax regime. So that option is also made available in the present bill also. But this new regime would be still a default scheme. Now deductions not available under section 115 BAC of the existing Income Tax Act are also not available in the present bill. So you would not be eligible to claim various deductions of chapter 6A except a few. So all those things which are existing in the present section 115 BAC, that has been incorporated in the new section 202 of the bill. So other than this, the new taxation regime remains the same. Now TDS and TCS provision. Now presently we have a number of sections starting from 192 to 199, rather 201 and 20 up to 206. All these are related to TDS and TCS provision. Now what has been done, that all these sections has been now consolidated in one section, that is section 393. And in section 393, 3 tables has been made out. They would be relating to one table relating to the TDS of resident, another is for non-resident, and third is from any other person other than resident and non-resident. And the respective table for each category specifies the nature of income or the monetary threshold, payer and the person, and the applicable rate of TDS. So instead of in a written language, it has been now changed in a tabular form. And one of the example, for example, if it is income by way of rent. So what is the nature of income? It is mentioned. Who is the payer? Person other than the specified person. What is the rate? So threshold limit is also mentioned here. Rate is also mentioned here. So everything is pictured in one table. And there is separate table for non-deduction of tax at source and declaration for non-deduction of tax at source. So everything has now been regrouped into a tabular form to have a easy reference of TDS and TCS provision. Now, similarly, the provisions of TCS, which is contained in section 206C, is now covered in section 394. And 394, which relates to the TCS, there is one table where all these things has been rearranged in a tabular form. Now, apart from this, certain provisions which were scattered in different sections in the present act, they have been now incorporated in the present bill also as an independent sections. That is for certificate for lower deduction or lower collection of tax at source, compliance and reporting, filing of statement, consequences of failure to deduct or collect tax at source, and processing of the statement. So they have been incorporated as an independent section in section 393 and 394. So that has been done in the present bill. Now we have a definition of virtual digital asset in section 247 capital A. So now that virtual definition, digital asset definition is now broadened to include any crypto asset which has digital representation of value that relies on cryptographically secured distributed ledger or similar technology to validate and secure transactions. What is the exact interpretation of all these words? The time would tell us that what is exactly the meaning of all this, but it has been broadened from the present definition of digital asset. And this virtual digital asset has also been included in the definition of undisclosed income for the purpose of search assessment. So in that definition of search assessment, which is now a block assessment, so there in the definition of undisclosed income, the virtual digital asset is also incorporated. So far as clubbing provisions are concerned, there is no change as such. Only language has been simplified and redundant provisions has been removed and formula has been introduced for better understanding and certainty in the computation. Now, Chapter 6A of the Income Tax Act. So presently, we have large number of sections in Chapter 6A. So even in Section 80C, there are number of subsections. So all those has been now grouped in a new schedule, that is Schedule 50. Other things almost remain the same. The words has been the sentences has been now broken down to have a easy understanding and easy reading. Similarly, Section 80G, which provide deduction to some for 100% and some for 50%. So that has now been separately provided that these are 100% deductions available, and to these trust and institution 50% would be available without making any policy change. Presently, we have for this bank interest and FDR interest, we have two sections, 80TTA for general public and 80TTB for senior citizens. So that is also now merged into one single section with clear definition. And similarly, wherever there were any other confusion, to make it clearer, it has been the language has been modified to that extent. So these are the changes made in chapter 6. Now, so far as return of income is concerned, that is divided in two parts. Part A pertains to obtaining the PAN number and part B pertaining to the filing of return of income. So the proposed section 263(1)(a) of the bill lists out the various categories of SSC who are required to file their return of income. Presently, that is contained in subsection 139(1), then 2, 3, 4, 4A, 4B, 4C, 4D, 4E. So that is now by way of subsection. So that has been consolidated at one place. Now the due dates for filing of return of income for each category remains the same, but now it is presented in a tabular format for a better understanding. The belated return, revised return, and updated return, that remains the same, which is in the present year. So there is no changes as such in the law, but they have been more structured and presented in a tabular form. Now, so far as assessment procedure are concerned, 153. So now proposed to be aligned. Otherwise, there is no major changes so far as assessment procedure is concerned, except that so far as the meaning of information for the purpose of section 148 is concerned, the law now provides that you can directly issue notice of 148 without going to the procedure prescribed under section 148A. So that has been broadened.
Jyoti ji, sir, I'm really sorry. Jyoti ji,
Yes.
please mute your mic. Jyoti ji. Jyoti ji, please mute your mic.
Fine.
Jyoti ji. Sorry, sir, to interrupt you.
No issue, no issue. So far, I think I have also taken up my time. So within 2-3 minutes, I would be concluding also. So this information has been broadened that if you have an information by way of any direction of approving panel or any finding or direction contained in an order passed by any authority, tribunal or court, then you need not to take recourse to section 148A. You can directly issue notice under section 148. Now the various faceless scheme that has been consolidated into one section, that is section 532, which confers power to the central government to frame a scheme for eliminating the interface with the SSC. So all those things remains the same. Advance tax, as such, there is no change. Redundant provisions has been removed. And formula has been incorporated for computation of advance tax liability. Refund and interest, also formula has been now used, that how the interest is to be calculated by giving a formula. So that those changes has been made. So effectively, these are the major changes which has been proposed. And apart from this, there is a mapping of section also, that what are the old section and what are the new section of entire 819 section of 1961 Act vis-a-vis 536 section of the present Act vis-a-vis the schedules. So I would just show in a minute that how that has been mapped. So it is available on the website also, so one can look into. So what they have done is for example, in section 1, we have short title, extent and commencement of 1961. So the section of the latest draft is also 1. So it remains the same. Definition is section 2, it remains section 2. But in definition, section 215 proviso, that is the definition of charitable trust and institution, that is now incorporated in non-profit organization chapter, interpretation. So the relevant section is 346. Previous year, 3 remains the 3, 4 remains the 4, 5 remains the 5. 5A, which is apportionment of income between spouses governed by the Portuguese Civil Code, that is now incorporated in section 10. Residence remains 6. Income deemed to be received and dividend income, that is now incorporated in 7.1 and 7.2 instead of 7 and 8. Income deemed to accrue or arise in India, section 9. 9A, certain activities not to constitute business connection, it is 9.12. Income on receipt of capital asset or stock in trade by a specified person for a specified entity. 9B is replaced to section 8. Incomes not included in total income. So section 10 is now replaced to section 11. And then individual section wise, it is incorporated in the various schedule. I have just mentioned that section 10 is now incorporated in 6th schedule. So individual section is incorporated in which schedule? That has been tabulated. So likewise, each of the section of the present act, where it has been incorporated in the present bill, either by way of a section or by way of a schedule, or wherever the redundant sections are there, they have been omitted. So everything has been tabulated in this entire table. For example, this section 10A, provision, special provision in respect of newly established undertaking in free trade zone, etc. Now that has become redundant. So it has been omitted. So it has been mentioned, it has become redundant, so not incorporated in the new bill. Now some section has been omitted. For example, we have just discussed 11.1 explanation, income from the property held for charitable trust or religious purpose. So that is now incorporated in 335C, but explanation income from the property held for charitable purpose, explanation 1, that is omitted. Similarly, wherever it is omitted, it is mentioned omitted. Where it is redundant, it means it is not incorporated. And wherever it is converted into a schedule, then a schedule reference is given. And wherever it is converted into a new section in the proposed bill, so the corresponding section of the new bill has been given for ready reference. So entire 819 sections of the Income Tax Act, how it has been incorporated in the present bill and the various schedule, that has been tabulated in this chart. So friends, with this, I would conclude my talk. If anything is to be discussed or any further query is there, it is welcome.
Thank you so much, sir.
Yes.
So now we open the floor for the question and answer. If you have any query, please post the query. Sir, one question is there.
Yes.
What are the major changes in the registration process of a charitable trust?
No, in process, there is no change. Whatever change was made in this bill itself, Finance Act, this Finance Bill 2025. 2-3 changes were made, not in the registration, but the changes which they made in this present bill, which is also incorporated in this bill. One was that if there is a small violation, a technical violation, then section 12 AB sub clause 5 or 5 or explanation. So there was a explanation that if there is a procedural lapse in filling the form, then also your registration can be cancelled. So that was omitted in this finance bill. So that has been incorporated in the proposed bill also. As such, in registration procedure, there is no change. One change which has been made was that if you are a small organization, then your registration, instead of 5 years, it would be valid for 10 years. So there they have put some quantum that up to 1 crore of receipt of institution, it would be for 10 years instead of 5 years. So that changes is already made in the present bill, which would take the shape of act after it is passed by the parliament. So all those changes has been incorporated in this new bill also. except that in the process of registration, there is no change.
Sir, another question is there, whether tax audit is allowed to other professional also in the new bill?
No, not yet.
There is only query.
Fine.
So as we conclude this informative and insightful webinar, I, CS Poonam Khandelwal, take this opportunity to express my heartfelt gratitude to everyone who contributed this to making this event in a success. First and foremost, I would like to extend my sincere thank you to our distinguished speaker, CA Yash Dadda sir and CA Prakash Parwal sir, to offering a detailed perspective on the upcoming changes in taxation and GST ISD mechanism. I special thanks to our CP committee leadership, CA Satish Kumar Gupta sir and CA Vishnu Agrawal sir, who take this leadership and continuous efforts in promoting professional education and learning. I would also like extended my gratitude to CP committee of ICAI for curating such an engaging sessions on that help professionals stay updated with tax and compliances landscape. A big thank you to our organizing team, technical support staff, and ICI member who ensure the smooth executions of this webinar. Most importantly, a huge thank you to all our participants for joining us today. Before we conclude, I encourage everyone to continue learning, stay updated, and participated in future CPE webinars. With this, I offering bring today's session a close. Thank you all of you once again. Have a great evening. Thank you so much.
Thank you.